Welcome. Today, we are unlocking the trillion-dollar mystery that absolutely disrupted modern finance. We're cutting through all the noise to distill the core mechanics of Bitcoin, straight from the foundational texts. Let's just jump right in. Our story actually kicks off in early 2009. Now, picture the backdrop. We're right in the thick of the 2008 global financial crisis. Massive bank bailouts are everywhere. And right then, the very first block of the network, the Genesis block, is mined. No flashy Silicon Valley launch party, no PR team, just a quiet release that would organically grow into an entirely new asset class worth trillions. But here's the kicker, and what's at the very heart of this tech, it's all about what's missing. No company, no bank, no government. Literally every traditional financial system relies on some massive central authority, right? But Bitcoin? It was launched by a totally unknown entity. There's no CEO, no customer service hotline to call, and definitely no central bank tweaking interest rates. It's an entirely decentralized architecture from top to bottom. And to get this monumental, world-shifting idea off the ground, it didn't take a skyscraper packed with servers. It all started with just a 9-page document. Yep, the famous Bitcoin white paper. Those 9 concise pages laid out a mathematical framework that would go on to challenge the most entrenched financial institutions on the planet.
So let's jump right into Section 1, the problem with banks. Why does Bitcoin even matter?
Think about how things worked before this. Sending money internationally, you practically had to ask your bank for permission. They take days to settle the funds, they skim a hefty cut through high fees, and ultimately they hold the power to just freeze your account or say no altogether. Bitcoin flips that entirely. It proposes a totally different architecture. You send money to anyone, anywhere in the world, in just minutes. You completely cut out the bank acting as a middleman. It's a real game changer.
Which brings us to Section 2. Enter the blockchain, the famous shared notebook.
So how do you actually make a trustless system work without a central boss? Well, you use an immutable ledger. It's essentially a giant digital shared notebook. But this isn't some private database locked away in a corporate vault. No, it's a decentralized ledger. Thousands of computers, called nodes, scattered all over the globe hold an exact, real-time copy. Every single transaction gets permanently recorded there. Nobody owns it, nobody controls it, and thanks to some heavy-duty cryptography, absolutely nobody can erase or alter what's already been written. The life cycle of a transaction here is actually incredibly elegant. Let's break it down. Step 1, you send the Bitcoin. Step 2, instead of a traditional clearinghouse checking your balance, your transaction is verified by those thousands of independent nodes running the network. Step 3, once the math checks out, it's permanently stamped into that shared notebook. Settlement is finalized. Just like that, you've moved value globally, securely, and instantly. Now let's look at Section 3, the digital gold standard. This is all about why it actually holds value. It really all boils down to one highly specific number, 21 million. This is the ultimate dividing line between Bitcoin and regular fiat currency. There will only ever be 21 million Bitcoin. Ever. That hard supply cap is permanently hard-coded right into the protocol. Contrast that with government money, where central banks can just print more at will, and you start to see the appeal. It creates absolute, mathematically verifiable scarcity. And that scarcity is exactly why you'll constantly hear it called digital gold. The parallels are honestly pretty striking. Just like physical gold, the supply is strictly limited. Plus, mining new coins requires a massive amount of computational energy, a consensus mechanism known as proof of work. Because of these unique properties, a huge and growing number of people treat it as a serious store of value. It's essentially viewed as a systemic hedge against the debasement of regular currency. And finally, Section 4, your biggest questions answered. Let's tackle some common skepticism. Naturally, the first thing anyone asks when looking at digital money is it actually safe? I mean, we see headlines about crypto hacks all the time, so questioning the security of the underlying protocol is a completely valid starting point. But here's the wild reality. The Bitcoin network itself has never been hacked. Not once in over 15 years of running 24/7. The core cryptography and that decentralized ledger are an absolute fortress. When you hear about millions being lost, it is almost always due to user error. Things like leaving funds on sketchy, unregulated third-party exchanges, or someone just losing their private keys. The base layer itself, it's rock solid. Then, of course, we hit the classic psychological roadblock, the timing question. People look at the insane historical price charts and inevitably think, okay,
Did I miss the boat? Is it just too late to buy?
Context is absolutely crucial here. Believe it or not, mainstream financial analysts have been confidently declaring it too late since Bitcoin was trading at just $100. Obviously, any financial decision requires your own due diligence, but history shows us that FOMO, that fear of missing out or fear of being too late, has literally shadowed this technology since day one. Which perfectly circles us back to the origins of the whole thing. We've got this globally distributed trillion-dollar financial juggernaut, all sparked by a simple 9-page PDF. So who actually wrote it?
Well, the author went by the pseudonym Satoshi Nakamoto. And to this day, nobody actually knows who that is. Was it one brilliant cryptographer, a whole team of developers? No clue. In 2011, after making sure the network was stable and running on its own, Nakamoto handed the reins over to the open source community and just vanished, completely disappeared. It genuinely remains one of the most fascinating unsolved mysteries in modern history.
So you've now got a solid handle on the foundational architecture, how that immutable ledger works, and the economics driving the value. But if we zoom out for a second, there's an even bigger debate raging right now. How does Bitcoin stack up against smart contract platforms? Specifically, Bitcoin versus Ethereum. Which one is actually building the future infrastructure of our financial world? Keep that exact question in mind, because that's exactly what we're diving into next time. Thanks for hanging out, and keep learning.